Hi, welcome back. As promised, we have Viktor Shvets of Macquarie who joins in from the sidelines of the Macquarie conference. Victor, thanks so much for joining us. Earlier when we had spoken to you, you had indicated that India has been a safe harbor in a global storm. I mean, even in the last 1 month, we've seen the Indian markets outperform both the emerging market and the Asia ex-Japan index. Do you get a sense that the time has come to put fresh money to work in India after the fall that we've seen over the last few months?
Well, I think emerging market performance overall really depend on three things. Number one, liquidity has to stay high. Number two, volatility has to stay low. And number three, reflationary pulse needs to improve. Right now, we don't have any of those elements working. So that's why emerging markets as a whole continues to struggle. As far as India is concerned, there are a couple of pluses going in favor of India. Number one, it's a continental-sized country, which is not quite as impacted by trade tensions. Number two, it has a lot of inbuilt liquidity within the country itself. Number three, external vulnerability is there, but it's certainly not as extreme as what you find in some of the other areas of emerging market universe. And perhaps even more importantly, when investors look at companies and companies they want to invest, India is quite well represented across a range of industries. And I think that's why India remains one of our favorite markets. But having said that, as I said, it all depends on the global flow and what that global flow will do. And India does need ultimately some degree of equilibrium. In other words, India has difficulty tolerating very extreme outcomes, either high volatility or too high dollar or too low dollar or too high commodity price or too low. So India will still be whiplashed, but in my view, it still remains one of the best choices to make within emerging market universe.
Okay. Good morning, Victor. Thanks for joining us. What's your sense of the way crude has moved? Is this more supply dominated? What's the Macquarie view? Are we going to get this lower? Because that seminally changes the picture for India. Today, bond yields are down by about 10 basis points compared to what they were 48 hours ago. Therefore, your view on that commodity, and therefore, does that improve the India view?
Yeah, well, it absolutely improves. As I said, India doesn't like when commodity prices are too low, but it also really doesn't like it when commodity prices are too high. So CRB index somewhere around 180, or 185, all prices around the current level is really the Goldilocks for India. What drives oil prices? It's the variety of factors. At the end of the day, you have to remember that oil is a financial instrument. It is not a commodity. Bulk of trading in oil is now through various financial instruments. So what you're doing, you're basically discounting events that might or might not happen, which really have very little to do with demand-supply situation. Whether it's political changes, whether it's Khashoggi's case, whether it's Saudi Arabia and Russia deciding what to do with the output, whether it's concern about longer-term slowdown in demand. So one has to remember that financial markets always anticipate and reprice the future very, very quickly, whereas the fundamentals don't change that quickly at all. So what you're seeing is financial markets now repricing in a matter of seconds. So the 5%, 6% moves per day is equivalent of 1% move, 5-10 years ago.
Okay, by the way, the equity markets have now moved into the red. So very quickly, all of the early morning gains have been given up. And it's led by IT stocks. Just don't lose sight of that. Infosys, HCL Tech, TCS, Tech Mahindra, all under pressure right now, down about 2 to 3.5%. Victor, in the early part of 2019, are we looking at a situation where money could move out of China and into markets like India purely because of the Chinese growth slowdown and the broadening of the trade tiff there?
It's very hard. If you look at 2019, the question is what's going to happen to global liquidity. Right now, global liquidity is compressing incredibly fast. That implies the public sector liquidity, which is down from 16, 17% down to only 3% globally. That applies to M2 and M3, which are down from 12% to only 3 or 4%. And US dollar liquidity. Last year it was positive 5 or 6%. Today it's negative 3. So we're facing a very massive contraction of liquidity. So as we go into 2019, the question is whether we will be able to reverse it, either through public sector or private sector. There are other complicating circumstances, things like divided legislature in the United States. What does it mean for stimulus, if any, that is going to come through in the United States in 2019-20? How hawkish would Federal Reserve become? Also remember that we're facing a potential revolution in Europe in May 2019. That's where you got European election. And what we saw in Bavaria, what we saw in Hesse, what we saw in Italy, I think is going to get replayed in May across European Union. The middle ground is collapsing and all the votes will go into extreme left and extreme right. Remember that Mario Draghi is leaving in October 2019. So who is going to run ECB? So there is so many complicating factors. And of course there is always China. And China is caught between declining domestic demand, Donald Trump and a trade, as well as desire to rebuild its economy in a different form. So people who are punting that China must stimulate through real estate or infrastructure might be surprised. Perhaps they're going to try stimulate in a different way. So when you start looking into liquidity into 2019, there are so many variables that could go terribly wrong. My personal feeling in the first 6 months, things will get very rocky. And volatility will increase significantly. But at the end of the day, as you go to late 19 and 2020, at the end of the day, nobody wants to commit suicide. Neither United States, nor Federal Reserve, nor China are really in a suicide business. So at the end of the day, they have to see eye to eye. And remember again, neither India nor emerging markets can work unless United States, Federal Reserve, and China see eye to eye. So I think it's much more significant issue than just some money floating out of China into India. I think we're facing a very significant global contraction in money supply right now.
Oh yes, there is that backdrop for sure. But of course, if the growth scare in China and in the EM start hurting the US, one hopes the Fed also will change its mind. As you say, nobody is in a suicide pact. But Viktor, finally, before we let you go, a lot of people complain about valuations in India and earnings growth. Earnings growth not having delivered for the last maybe 6 years. Does that scare you? And in spite of it, are there sectors that look attractive? With India, you always were concerned, and as you correctly said, two areas. One is earnings per share growth rate, the other one is valuation. If I think over the last 6 years at least, every year India starts with the same earnings per share number, 20-25% growth rates, and India never delivers it. And the multiples are consistently at least 1-2 standard deviation above the mean and consistently above average. Now, what drives this forgiveness that investors feel towards India is really two things. Number one, a possibility of circular or structural reform in India. India generally is poorly governed and poorly administered country. But if you can actually administer it better, and that's the whole promise of Modi government, if you can actually administer it better, from a low point, you can generate significant growth rates and less inflation for a number of years. And I think that promise of better administration, only partially fulfilled so far, but that promise keeps investors in the game. And I think the second thing that keeps investors in the game is, as I said, the spread and the quality of Indian companies. I tend to prefer more consumer-oriented, consumer discretionary companies, and even though they are expensive, they're one of the best companies you can find globally. Because if you think of developed markets, for example, brands have largely disintegrated, but not in India, primarily because the level of trust that consumers have in the products they're buying is incredibly low. So the brands, whether it's Hindustan Unilever, whether it's Goodrich, whether it's United Spirits, whether it's Maruti Suzuki, is high. Much higher than what you find in developed countries. So I think the capacity to grow in those areas are still there. Thank you very much, Viktor Shvets. Pleasure listening to you. we have to wind down on the show. So thanks a lot for joining us. And we also are waiting for better governance. We will have a chance to hold our governors to question in about 5 months. Let's see what happens. We have to